Have you ever wondered why some order blocks work and then others get completely ignored by the market? That's because there's something you don't know that is making you mark the wrong order blocks. And if luckily you mark the correct order blocks, you don't even mark them out well. In this video, I'll be bringing to light why price doesn't tap into your order blocks, why the market surpasses your order blocks and still goes your way, why your order blocks get completely ignored. When I got into smart money concepts newly, I was so fascinated about the idea of order blocks because instead of marking out a whole resistance zone and then price sleeps there for hours, I just need to mark out a more precise candle, which if I'm right, price just taps in and leave. Over time, my order blocks were not working as much and many were getting ignored, leading to more losses. So I started to feel like order blocks in general no longer work until I met a mentor who broke it down for me and explained what I was doing wrong. After studying what he showed me, my results went from this to this. So this is what you should know about order blocks. Order blocks are found at the origin of swings, either swing highs or swing lows. If there's any place you should be looking out for an order block, it has to be the origin. Now, what makes these order blocks which you find at the origin valid is the presence of a break of structure and a fair value gap. Meaning, if one is missing, either a fair value gap or break of structure, the order block at the origin is invalid.
Now let's look at some examples. We see that there's a break of structure to the upside, and now if at all we should have anything on this example, we should be looking forward to having an order block. Why? There's origin. So origin, which is one, check. Break of structure, which is second, check. But is there a fair value gap? There's no fair value gap. Within this range that the break of structure happened, there's no FVG within this range. Okay, within this range, there's no FVG. Yes, you'd say there's one here. As you can see, it just immediately got filled by the market. That is not what we're using to qualify this swing as a swing that has a valid order block. So it's either this swing now comes into something on the higher time frames, like a fair value gap on order block, and sinks down. But I could tell you that this particular order block will not hold. Okay, let's see this. What happened? Look at this right here. This was the order block that ideally we should have marked, or even this. But what happened? It did not hold. Rather, what the price do? Either price came to a level up here that was going to hold, or price now broke this low. This is also an origin of the swing. Okay, and then we have this correct sell side order block, which has a fair value gap. As you can see in there, price came in there and tanked all the way till this liquidity was taken. So this thing that you called order block, you were actually being the liquidity. It's not an order block. When there's an order block, there has to be an inefficiency. There has to be an inefficiency in price. It's compulsory that there's an inefficiency in price. Let's look at a correct scenario. If I said those two, they're wrong. Now here, clearly see there's a break of structure. This is the origin. This is the order block. So if we're hitting our checklist, origin check, break of structure check. Is there a fair value gap? Yes, there's a fair value gap. There's a fair value gap here. Can you see the fair value gap? So the space in here is the fair value gap. There's a fair value gap in there. All right. So fair value gap check, origin check, break of structure check. This is an actual order block. That's what an order block should be like. Look at this scenario here. Break of market structure, break of structure check. Is this the origin? Well, for this particular swing, this is the start, so we could consider that as origin check. Where's the fair value gap? None. This is not a valid order block. And if you're marking out this order block, you mark out this entire candle before the move downward. Okay, and look at this. There is no order block here. It is invalid. If price comes back here, if this holds price, it's just luck. So ideally, price can stick this out. Let's see another example here. So there are two examples in one right here. So basically we have this swing that broke the highs, okay, and then price came back. This is the case that worked, but this order block is not a valid order block. This is not valid at all. This is not valid. Now, another scenario, we've gone up, came down, or it came up again. This is an origin. There is a fair value gap. There's something that looks like an order block in here, something that looks like an order block, but then what is wrong here? There's no break of structure. So break of structure, no break of structure, origin, check, fair value gap, check. So this is not a valid order block structure. That's what I mean when I say it is not an order block if it has one or both missing, which is it could be in the origin quite all right, but if there's no break of structure and a fair value gap in that swing, do not take that setup.
Now moving to the secret sauce, why price doesn't tap into your order blocks. You could have the order block at the origin as well as it broke structure and carries a fair value gap and price still doesn't get to it. Now there are two major things that could cause this. First, price mitigated an FVG before the order block and dropped from there. Second, the market is just engineering liquidity which it's going to go back and grab. The third scenario why price would not tap into your order block is because what you marked is not even an order block at all. You failed to apply the things which I said earlier when marking out order blocks. Now the next order block secret sauce. Have you noticed that there are times the market surpasses your order block and moves your direction? That is because the markets grab liquidity resting above or below your order block. And if a liquidity pool is swept, as you know, market is likely to move the opposite direction. So if your bias is bearish, it is still valid even if the order block has failed. Now, if you do all this and your order block still gets completely ignored, only one thing can be the issue. You're on the wrong side of the market. Here's what I mean.
We have the market delivering bullish like this, okay, and then all of a sudden we break downwards. Let's assume this is a higher time frame like the 4 hours or the daily time frame. We now have a move like this. A break of structure has been created and carries a fair value gap as well as an order block within the fair value gap. So it's only valid for you to allow price retrace into the order block in this case. Okay, let's extend the order block. Allow price retrace into the order block in this case, and you try to look for buys. But then the market moves up and sweeps you out. Okay, now the reason this happened is because you're on the wrong side of the market. This is a bearish change of structure. Okay, and the market came back into an order block or a fair value gap, something in the discount zones, all right, and gave confirmations for sell. This is literally the target liquidity. So you now became the liquidity, all because you are on the wrong side. So you could have an order block break of structure, and the break of structure carries a fair value gap, and you still are on the wrong side of market. You would lose. You would lose the setup. Better things that could have happened is, let's duplicate this to another. So in this case, if we have had a break of structure, similar scenario, okay, and price didn't come into that order block and returns to a valid buy side order block, we could take the buys because the market first things first engineered liquidity here. You could then look to take price to the order block. All right, so either you have your targets here, you take profits here, or you have your targets here entirely. Now, why this is more valid is because this is a short-term structure. It's just the market trying to get to the order block or the major zone before it drops. All right, so you can be a part of these buys, but when it has come into the order block already, you have no business buying. The only thing you should think about is selling. But when you try to take price here, if you didn't meet this, okay, then you can now sell from this. This is being on the right side of the market, and that's why market structure overall is very essential.
Watch this video where I taught top-down analysis and how the market is fractal to get an in-depth understanding of what I mean. With that said, I've done my part. Now you go study. If you don't understand any of the things I said here, hit the comments. I'll be answering all of them. And if you understood, join the free community and see how I trade these things. If you want to reach out to me directly, my Telegram handle is in the description box. I'll see you guys in the next one. Be safe.